Hello viewers, welcome to my channel. Same revenue, same industry, but completely different results. One company makes 5% profit, another company makes 20% profit. Who is stronger? Most people look at the numbers, but smart investors look at the ratios. Now, one decision, two outcomes. One investment gives 80% profit, one investment gives, another investment destroys 40% wealth. What changed? It's not luck, it's not timing. The difference is financial understanding. In this particular video, we'll be mainly focusing on the meaning of ratios, how to calculate ratios, how to interpret ratios, how to identify the red flags of a company by using ratios, how to identify the growth signals of a company by using ratios. So this will be our major discussion. Now, what is ratio analysis? So financial statements gives you the data, but ratios gives you meaning. So revenue 100 crores, profit 10 crores, and the profit percentage is 10%. That's ratio analysis for you. Ratios create comparability. So company A 500 crores revenue, company B 200 crores revenue, and the profit of company A 25 crores, which is 5% of company A revenue, and company B profit is 40 crores, which is 20 crores, 20% of company B revenue. So smallest company can be a stronger. Always you should not mislead with the numbers. So here the ratio analysis comes into the picture. Now, why ratio analysis? So normally ratio analysis is mainly used to understand the performance of the company. It means how it is earning. We'll be using profitability ratios for this. And in order to know whether the company can survive, we'll be using liquidity ratios. In order to understand the debt structure of the company, we'll be using solvency ratios. And in order to know whether the company is mobilizing the resources effectively, we'll be using efficiency ratios. So all the decisions depend on these particular ratio analysis. Now the next question is who uses the ratio analysis? Now who requires these ratios? Now, investors need ratios for the purpose of stock selection. Bank depend on ratios for loan approval. Analyst depends on ratios for recommendations, and managers depends on ratio analysis for performance improvement. So one tool, multiple decisions. So in order to go for ratio analysis, there are certain steps. Now, if you see the step number one, so that is collection of data. So we need to collect the required data for going for ratio analysis. So everything starts with collecting data. Income statement, balance sheet, revenue, expenses, profit, liabilities, profit, and in addition to this, we'll also be collecting the data from cash flow statement, cash from operations, cash from investing, cash from financing. So the first step of ratio analysis is collecting the required data. Then after collecting the data, next comes the calculation part. So we'll be calculating the required ratio. Here I gave an example of net profit margin, which is computed by profit by revenue. So here the net profit margin is 10%. It means the data which we collected will be converting this particular data into a meaningful insights. That is nothing but calculating the ratios. So after collecting the data and after calculating the required ratios, the next step is comparison. Now, whatever ratios which we calculated in step 2, we try to compare it with the previous performance of the company. Suppose let us assume that if your net profit margin for 2026 is 10%, we try to compare that particular ratio with the previous financial year 2025, 2024, 2023 in order to understand the growth. Similarly, we'll also be comparing it with the competitors. And the next thing is interpretation. So always do remember that a high ratio doesn't mean that always it is good. A low ratio, we cannot say that always it is bad. Always do remember the context matters. Example, normally it is very common to have high debt for infrastructure industries. Then if you see the types of ratios, so normally if you observe the types of ratio, there are profitability ratios which mainly focus on earnings, liquidity ratios which focus on survival, solvency ratios which focus on risk, and efficiency ratios which focus on usage, and finally market ratios which focus on investors view. When it comes to the profitability ratios, now profitability ratios, as we discussed earlier, it mainly focus on the efficiency. It means how the company is performing. So here we can see the net margin of a company is 20%. So these profitability ratios mainly focus on earning power of the company. Then liquidity ratios, which mainly focus on short-term survival, nothing but it mainly focus on the short-term solvency of a company, and this can be considered as the short-term survival indicator of a company. So here we took an example of current ratio. So if a company current ratio is less than 1, then definitely we can consider it as risky, and always we assume a current ratio of 2 is safe. It means what is a current ratio of 2 means if a company current liabilities are 100 and if their current assets are 200, then we can consider that the current ratio of a company is 200, nothing but 2. So we need to know whether the company current assets are sufficient to meet their current obligations. So that is the reason we consider liquidity ratio as the short-term survival indicator. Then comes the solvency ratios. It mainly focus on the long-term stability. So it is considered as an indicator which checks the long-term stability. So in this case, if example of solvency ratios, debt equity ratio, and we do also consider interest coverage ratio as one of the most commonly used solvency ratios. So if a debt equity ratio of a company is 2 is to 1, then we can consider it as high risk. Efficiency ratios. So efficiency ratios mainly focus on how effectively the company is mobilizing their resources, how effectively the company is using their resources. Here there is an example of inventory turnover ratio, and you can see the formula also to compute the inventory turnover ratio. So the higher the efficiency ratio, the company is better in utilizing their resources. The next one is market ratios. So market ratio mainly focus on market perception. So one of the most commonly used market ratio is price earning ratio. So if a company is having high price earning ratio, we can consider it as growth expectation. And if a company is having low price earning ratio, we may assume it as risky, or we can also consider that the stock is undervalued. And how we can identify the red flags by using these ratios. So normally by using profitability ratios, if you understood that the profit margin has been decreasing, then it can be considered as a red flag. If a company debt is increasing, it can be considered as a red flag. If a company cash flow is decreasing, it can be considered as a red flag. If a company inventory is increasing, then it can be considered as a red flag. So these are nothing but the hidden risk inside the numbers. So we can use the ratios in order to identify the red flags. Similarly, we can also use ratios to identify the growth signals. So if you observe the most common growth signals, if a company return on equity is increasing, we can consider that it is a growth indicator for a company. If the company margins are stable, we can assume it as a growth signal. nothing but the growth element. If a company is having a controlled debt, then it is a growth signal. And if you observe that if the EPS of a company is growing, then it can be considered as a growth signal. So these are certain growth signals which we can compute by using the ratios. Normally, if you see, there is a just small example, company X and company Y. So normally, in case of company X, you can observe it is having high debt and falling margins, and company Y stable margin and low debt. Now, this high debt, falling margin, stable margin, and low debt, we just try to get a conclusion by using the ratio analysis. We try to understand. Suppose example in 2026, the company debt equity ratio is 40%. In 2025, the company debt equity ratio is 35%. In 2024, the company debt equity ratio is 25%. And if you assume that this company is operating in IT sector, and if you see the industry debt equity ratio that is 30%, but this company debt equity ratio is 40%. So definitely we can consider that it is risky to put your money in this particular company. And similarly, when you compare the margins also, the net profit margin of the company is 20%, but the industry is giving a margin of 30%. Or the current net profit of a company is 20%, and if you compare it with the last year, it was around 30%. It means there is a fall in the net profit. So it is not safe to put your money. So all these interpretations, all these computations is possible with ratio analysis. So financial statements mainly focus on a story, but ratio analysis projects the reality. Understand deeply to make the wise investment decisions. So master finance, not just learn, try to develop an art of analysis and grow in your career. Thank you very much for watching my video, and request you to please subscribe and like my videos, and it will encourage me to go for to encourage me to create more videos in future. Thank you very much.